The Ultimate Cash Parking Spot, a comprehensive guide to iShares 0 to 3 month Treasury Bond ETF, SGOV. As of February 3, 2026, the iShares 0 to 3 month Treasury Bond ETF, ticker SGOV, has become the definitive tool for investors seeking a safe haven for their cash. While the broader markets, driven by the AI-heavy Magnificent Seven or volatile small caps, can swing wildly in a single day, SGOV is designed to do the opposite, stay incredibly still while paying you to wait. For an investor in 2026, SGOV represents the closest thing to a risk-free return available in the public markets. It isn't an investment meant to make you rich. It is an investment meant to keep your money safe while earning a rate that competes with, and often beats, high-yield savings accounts, HYSAs. This guide breaks down the sawtooth price movement, the tax advantages for those in high-tax states, and the 2026 yield landscape that every beginner must understand. 1. What is SGOV? The ultra-short philosophy. SGOV tracks the ICE 0 to 3 month U.S. Treasury Securities Index. To understand SGOV, you have to understand the U.S. Treasury Bill, T-bill. When you buy SGOV, you are effectively lending money to the U.S. government for a very short period, specifically anywhere from 1 day to 90 days. Why the 0 to 3 month window matters. In the bond world, duration is your enemy. If you buy a 30-year bond and interest rates rise, the value of your bond crashes. However, because SGOV only holds debt that matures in a few weeks, it has almost zero interest rate sensitivity. Stability. If the Fed raises or cuts rates today, SGOV's share price barely moves. Liquidity. Because T-bills are the most liquid assets on Earth, SGOV is incredibly easy to buy and sell instantly in your brokerage account, just like a stock. 2. The 2026 yield landscape. Earning while you wait. As we move through the first quarter of 2026, the era of free money, 0% interest, is a distant memory. Key statistics. As of February 3, 2026. SEC yield, 4.1% to 4.2%. While yields have drifted down from the 5% peaks of 2024, SGOV still offers a compelling return. For every $10,000 you park here, you can expect roughly $410 to $420 in annual income. Expense ratio, 0.05% to 0.09%. Note, iShares often use fee waivers. Currently, the effective cost is roughly $5 to $9 per year for every $10,000 invested. This is significantly cheaper than the 0.30% to 0.60% fees often found in traditional money market funds. AUM, Assets Under Management, now exceeding $70 billion. SGOV is one of the largest and most trusted cash alternative ETFs in the world. 3. The sawtooth pattern, understanding why the price drops. Beginner investors often panic when they see SGOV drop by $0.30 to $0.50 in a single day. This is actually a mechanical feature, not a sign of trouble. How the monthly cycle works. The climb. At the start of the month, the share price is low, usually around $100.3. Every day, as the Treasury bills inside the fund get closer to their payday, the share price rises by a tiny fraction. The peak. By the end of the month, the share price might be $100.65. This price contains all the interest earned during that month. The dividend drop. On the ex-dividend date, usually the 1st or 2nd of the month, the fund detaches that interest and prepares to pay it to you. The share price instantly drops by the amount of the dividend. The payout. A few days later, you receive the cash in your brokerage account. Important note, you don't lose money when the price drops. You are simply receiving the growth as cash instead of seeing it in the share price.
4. The hidden advantage, state and local tax exemption. For investors living in high-tax states like California, New York, or Massachusetts, SGOV has a massive secret advantage over a regular savings account. The federal law protection. Under U.S. law, interest earned from U.S. Treasury securities is exempt from state and local income taxes. HYSA, savings account. If your bank pays you 4%, you pay federal tax and state tax on that money. SGOV. If SGOV pays you 4%, you pay federal tax, but in most cases, you pay $0 in state tax. In 2026, with state tax rates in some areas reaching 10% or more, this tax alpha can make SGOV significantly more profitable than a bank account with the same headline interest rate. 5. SGOV versus money market funds, SPACs, VMFFX. Many investors ask, why buy SGOV when my broker already puts my cash in a money market fund? Transparency. Money market funds often use amortized cost accounting to keep the price at exactly $1. This hides the daily price movement. SGOV shows you the fair market value, which is more transparent but looks more volatile on a chart. Portfolio purity. Many general money market funds, like Fidelity SPACs, hold some private bank debt or repurchase agreements. SGOV is 100% Treasury-backed, making it technically higher in the safety hierarchy. Accessibility. You can buy SGOV at any brokerage: Robinhood, Fidelity, Schwab, Vanguard. You don't have to be a customer of a specific bank to get the best rate. 6. Risks to consider in 2026. While SGOV is as safe as an investment gets, it is not without trade-offs. Reinvestment risk. SGOV's yield is tied directly to the Federal Reserve. If the Fed cuts rates aggressively in late 2026, SGOV's yield will drop immediately. You cannot lock in a rate with SGOV like you can with a CD. Opportunity cost. SGOV is for parking money, not growing wealth. Over the last 100 years, the stock market has returned approximately 10% annually. If you keep all your money in SGOV, you will likely lose out on the massive gains of the innovation economy over the long term. Inflation risk. If the yield is 4% and inflation is 4%, your real return is 0%. Your money is safe, but your purchasing power is staying flat. 7. Strategy. Who is SGOV for? In the 2026 market, SGOV fits into 3 main buckets. The emergency fund. Since SGOV is highly liquid, many investors use it as their emergency fund. It earns more than a standard bank account but remains available to sell if your car breaks down. The dry powder bucket. If you are waiting for the stock market to crash so you can buy the dip, you park your cash in SGOV to earn 4% while you wait for the opportunity. The tax-efficient saver. If you are in a high tax bracket, SGOV is your primary tool for avoiding unnecessary state taxes on your savings. Conclusion. The foundation of financial safety. The iShares 0 to 3-month Treasury Bond ETF, SGOV, is the boring, reliable heart of a modern portfolio. It doesn't promise excitement, and it won't make you a millionaire by next month. What it does promise is that your $10,000 will be there when you need it, and it will have a few $100 extra attached to it for your trouble. The verdict. In a 2026 economy where volatility is the only constant, SGOV is the simplest and most effective way to get paid to wait. It is the ultimate tool for capital preservation and short-term income.